Good afternoon, everybody. Welcome back to the Opportunistic Trader. It's just after 1 January 8th, and we're joined by Tom McEntee and Vince Lanci to discuss options class, options seminar. These guys have each over 30 years experience, dealing with commodities, futures, options, strategy. A lot of great information between the two of them, and so they've been joining regularly to talk about a variety of subjects, and I'll let you guys take it from here.
Greetings, guys. Vince, it's been a while. Mike, obviously, thank you so much for that warm introduction. Vince,
Yes.
we haven't spoken since before Christmas.
Yes, since the holidays.
In that time, we had the much ballyhooed Christmas Eve bloodbath. Down to
Which
about
ended,
20.
which ended with the plunge protection team conversation with Minuchin clause, and then we rallied after that.
Oh, that was the Mnuchin. Did he come? Was the weekend where he came out and said there's ample liquidity in the system?
Dude, he spoke with. He spoke with the plunge protection team, aka the leading dealers, on Christmas Eve, and that was the low of the market. I would say that's the only reason we're up, because they were told to buy it and to protect it, and they would be bailed out. That's a little bit cynical, but it's more than a coincidence, in my opinion.
Yeah, I mean, it's just. But what fascinated me is when my brother-in-law works for Goldman. I am just absolutely shocked, and I always think, and perhaps wrong. I guess obviously, I mean, never assume like Oscar Madison. So I assume that anyone who works for Goldman is a very intelligent guy, and then a guy comes out with a statement like that unprompted. It's just absolutely ridiculous. There's ample liquidity. It's like, honey, I'm not cheating. I'm not cheating on you. Oh, what? You what?
Yeah.
Yeah. So then you've had this enormous spike, right? I think we're in agreement. I thought, going back to those days, I think I put this in the chat. 2375 was a big number for me. Down to that Feb 10 or two. It was February 10, 2016, 1810 low. The War of 1810.
Right.
So that 1810 low and the 2940 high. Made a 2375 midpoint. Obviously, went about percent through that. Went down about 2340, I think. And now
Right.
I think I did some scalping in between and some spiders. I have a tree on that I put on in the chat about 3 weeks ago. I think Gary Eisenreich has it on as well. A Feb 60, 65, 75. I mean, volatility was just. I mean, Spider Vol had to be pressing 30 out 30 days. 26,
Well,
27, like that.
Can we revisit that trade? But before we do, John Hasker asked us, a great question to start. I mean, it'll help us get off the ground. Before we get to specifics, he asked us, in our opinions, what is the most popular option strategy that pros use, like a go-to bread and butter option strategy? And if you see that on your screen, that's the question he asked both of us.
Why don't you take it first? What's yours? Then I'll give mine. There's no right.
Okay.
Right. No
Okay.
right
Well,
answer.
John, and anyone who's listening, anytime you get an answer from someone who has been trading for years, obviously they're going to bring their own bias to the table. So what I'm going to do is I'm going to give you 2 or 3 different answers, and one of them will be my go-to strategy, and by that I mean I trade volatility, so I'm most comfortable with this as a volatility risk strategy. Number one. The second strategy I give you will be what I have seen is the most common strategy by people who quote, know where the market is going. And number 3, I'll give you a strategy that is most commonly used, and that's a directional strategy. And I'll give you a strategy that's most commonly used by professionals who know that something's going to be in play. So I'll give you a couple examples, but starting out with the simplest, and I'll give you real examples. When an earnings report is going to come out, frequently you will see professionals, and professionals know that when you're trading options, they're giving up a lot of VIG or edge to market makers. Speaking as one myself, so market makers have a lot in the bid ask to buffer to cushion their trades. It's an implicit fee, is what it is. So big players will not go for slightly out. Really big players, when they trade options, they would prefer to trade stock with a stop as opposed to options. But when they go for options, and I know this from personal experience, of seeing big players play options. They actually will buy, if they think the market's going to go up, they actually will buy the slightly in the money call, 55 or 60 delta. And the reason for that is because they won't get faded as a buyer. Someone comes in and quotes a 20 delta call and say gold, I read them as a buyer. If it's worth 6, my market is 5 bid at 10. If they bid 9, they own them. But on an in the money call, typically market makers will make their markets a little bit lower. So if that in the money call is worth 12, I'll make the market 9 bid at 13, expecting them to be sellers taking profits. So savvy professionals, when they want to express a directional play that's going to happen within 30 to 90 days, will look at a 60 delta call or put if they're bearish. So that's classic. I'll give you players that have done that. Warren Buffett has done that. Philip Brothers has done that. George Soros has done that, and Great Lakes used to do that. They would actually do it in straddle form. So that's the very well-heeled, deep trading firm that wants to express a big delta, and they will do it with options that are slightly in the money because, A, if it's too much in the money, it's going to be impossible to get a tight market. You'll get a wide market as wide as the futures. And B, if it's too much out of the money, you'll get a faded market high from market makers. Second strategy that I have seen happen a lot is by pros. This time I'm going to be going with volatility or directional players. And this is a sell strategy, and it works if you do it properly. Basically, that would be a strategy that sells strangles or sells vol. Now, they call it strangle for a reason. You're strangling the premium. So a company, a trading firm that has a position, long or short, will sell a strangle, and they'll manage that risk as the market moves. So if they're short, let's say a product is trading $150, they'll short the 100, 200 strangle. And if the market goes up to 180, they may roll the call higher and roll the put higher. So that's the second most popular. That's probably the most popular vol selling. Now, Tom may give different perspective because he's on the equity side, but the most popular and profitable long-term strategy is to sell strangles and play the ergodics or law of large numbers. Now, for me, and this is as much a comment on how I like to manage risk and what I'm most comfortable with. There are two strategies that I'm very comfortable with. One, I'm super comfortable with. The other one, I'll sweat the risk because I think other people are scared to step into the breach. First one that I'm very comfortable with is trading the opposite side of anyone who wants to trade a three-way. So in oil, that market is dominated by three ways. A lot of times, producers will hedge by buying a put spread. They'll buy the 30 delta, sell the 10 delta, and then they'll sell the 20 delta call. So they buy a put spread, sell a call, and that's called a three-way as opposed to a threesome. And what they do is they sell vol, and they want to buy put protection for production, but at the same time they don't want to lay a lot of money out. I love taking the opposite side of that trade. Exactly, John. Right? I mean, how come every structure in options sounds like some sort of a sexual deviance hobby? So John just made a comment about that. So the three-way is typically done almost always by producers in the oil market. They buy the put spread, sell the call. And you can fade them all you want. If it's worth 6 to the put spread, you make it 6 bid at 12, they'll just buy it. And I love taking the opposite side of that trade because and you can use this in stocks too, because if the market goes lower, I have a little bit of negative gamma, but I have excellent change in vol. So as the market drops, I'll lose on negative gamma, but that negative gamma will be wiped out because volatility will explode. I typically end up being long vol anyway. And in the rally, I let my gamma run. So in the sell-off, I let my negative gamma run because I know that the volatility change as I get longer vol as we go lower will eat that negative gamma up, the vol gamma, for lack of a better word. And in the rally, I just sit on my hands and don't hedge my gamma and let it run. And as long as I'm flat premium, I'm okay. So that's a lot of professionals who trade oil are comfortable taking the other side of three ways. So I have typically short the put spread and long the call, and I can manage that risk well. But that's not a directional trade. To trade directionally, my personal favorite are time spreads. But I won't get too much into that because I have a feeling Tom's going to talk a lot about those. But that's basically it. Directional guys who have inside information or insight into the market will typically trade 60 in my markets that I play, 60 delta calls or puts to express big deltas with less options. 560 delta calls is going to give you a lot more bang for the buck than 520 deltas, and plus they don't get faded. The second strategy that I see frequently is on the sell side, selling strangles, and that's why they call it strangles. And the third strategy I'm describing to you from a volatility risk management perspective, I have no problem and love to take the other side of three ways. That said, if you're a directional player, you want to trade three ways against me. If you're bearish in the stock market, buy a put spread, sell a call if you can stomach that risk. I just love managing the vol risk and the stochastic process that comes with that. I hope that helps a little bit. I mean, there's whole sessions we can have on that. And in fact, you're giving me ideas that Tom and I could talk about the different ways to manage risk. But I've taken up enough time talking about that. I hope that helps, John. And Tom's going to give you his versions. Thanks.
Yeah, sure. No, that was pretty insightful, Vince, and I would concur. I mean,
do you see a lot of 60 delta call buying when you were trading on the floor for professionals?
Just trying to think. It's been a while. I remember a trade in Motorola. So this is 20 some odd years. So this is before the stock, before the freaking, what was the informatics? What they took over in 1999? Stocks trading on its way. I guess it got as high as 162, and then back down to 44. Anyway, boom, boom, boom. I remember a guy stock trading 105 and Morgan Stanley boy. Now this is 1995, so it's not 2018 with and decimalization and stock options paired with stock.
Right.
Some guy came in and just they didn't really pair it that way in those days. Now every trade comes in with a zero delta.
Right.
So you're guaranteed to get your stock. I'll pay $1 for these calls. I'll say the stock at $92, and
right.
Okay, right, boom, 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 and off we go. But in those days, they would usually, with the exception of a buy right synthetic market, if guys were buying out of the money calls, they were just straight naked call buyers, and it was dependent upon you to get your deltas to hedge off. Anyway,
right.
Stock trading 105, and a guy buys, I think earnings are next week or thereabouts, and I think Morgan Stanley bought 4,000 of the 110s, next week's 110s. They might have been, I think earnings were coming out, so probably $1 option.
Right.
No, it didn't really matter because they were like, well, I think the market on the screen is before. I think this is before decimalization. I think the market on the screen was 7A sustained. Boy, what I wouldn't give to go back to those days. 7A sustained, and all of a sudden he'd pay. Hey, I'll pay. 1.25 for 4,000. And that means that. And when he says that, he's telling you that he's got the seller. So either you sell them or somebody else sells them. Now that guy probably placed the stock, but whatever. Right. He's going to sell them at 1.25. And we filled them on the whole freaking thing. And then of course, then there was these are the days that the specialists and everyone ran to get the stock at the same time. Instead of tiptoeing in and getting all the stock, somebody ran in and bought a little bit of the stock, and then it was just stock ran all the way up to like 108 and change, where I think the last schmuck bought his stock, and then within about 10 minutes, it was 103. And
Yeah.
So I always wondered: is that guy a bear in bull's clothing? What was he?
I'm not going to step on what you're saying, but I'm going to when you want to, we'll come back to that. I will give you the oil trade that is just like that JP Morgan did to us years ago. When you're done that, and no,
I remember the story. That's kind of why I brought it up. I remember that story. That's exactly what happened here. So I don't know what the guy did, but whatever. To answer John's question, I mean, there's no real best strategy. It's what is the best method or mode to attain your goals, whatever they might be, to fit your thesis, whatever it might be, with the set of circumstances that are presented at this point in time. So that's what it is. I mean, right now, look, I mean,
what do you think? Let me ask you the question a little more pointedly. you're definitely answering the way I want to answer, which is depends on your risk profile. But from our experience, specifically from your experience, what have you seen when you can sense what's going on? What can what is the most dominant, simplistic, or complex strategy you see when a speculator or a fund wants to express an opinion directionally? Like, do you see the call spread by the professionals, or is that just retail? Do you see one by twos? Like, what do they like to do? What have you been on the opposite side of that's been spec players a lot in the past? And we know they don't spec that much.
Yeah. I would think. I'll tell you this: when you trade, like I remember, I used to trade a lot with SocGen, and they were pretty savvy in terms of volatility.
Right.
And you had to really respect their, I mean, hey, we respect their views, and they were spot on most of the freaking time, and they were just strict vol traders. So I mean, if we would have had this conversation 2 weeks ago, and I think it's still apparent today, it would have been a lot easier. But here's what I would say: I think pros, and I put myself into that category very, very loosely with exclamation point, with an
Right.
exclamation point. I think pros, 2 weeks ago, a week ago, maybe today, they're doing 1x2s. You're getting paid to sell volatility here.
Okay. So at inflated vol after a sell-off, they want to be short the market on direction, but the vol.
You don't even. I mean, like I was doing. I mean, Twillo. Look at them. I'll put the stock up. Hold on. Look at this. I mean, look at this.
Sure.
I've been referencing in the chat a few times now. I mean, this thing's that. Did I put up Twillo? I want to.
But while you're doing this, I think this brings up something we discussed off air. Professionals will do 1x2, selling the two, buying the one when vol is high, and they have enough money in their kitty and their bankroll to stomach a margin call if volatility blows out going lower, but directionally they're still profitable. However, retail will do 1x2s when volatility is at 12%, and they won't have enough money in their account
Right.
to cover the margin call, and that is the difference. It's bankroll management that's the difference.
Absolutely.
But you're saying
right.
at these elevated levels, you've been seeing more often than not 1x2s on the put spread side.
Yeah, well, I mean, that's what I've been doing. I've been trying to express a lot of directional bets higher in a lot of these tech stocks. I mean, look, Nvidia. I'm wrong on this. What did I do? I bought this spread. February. I bought this thing. Well, the stock. I don't know, Thursday. Whenever that last sell up was 24.40 in SPX. I think we were down around 29 or 30 in the stock. I bought the 60. I bought one of the 65s. You see what I'm cursing over, right? Bought one of the 65s. Sold two of the 75s. I paid even for it.
Right.
Okay, now it sets up. We'll figure two. Now it's like a 6 cent credit. I paid even for it and a 15-cent credit. I mean, it was just. And this morning it got to 40 cents. I tried to do more there. I couldn't get it off. With the stock, really, I'm like, this is crazy. I mean, it's a slight negative delta, but I know. I'll try to leverage vol with. I'll leverage vol with technicals. I got room up to 180 freaking 5 on this thing. I think 175 provides stiff resistance if we get that far. You would give me more of a credit, fine, I'll do it because I just think there's a pell-mell rush to get stuff on your sheets because the stock had maybe moved to 145 and you had some desperate shorts up there who got short at the 130 level. So I was trying to do that. Now another way to finance things is this way. This is the earnings month. And look, the stock's had an enormous move. I think it was at 290 at one point.
Okay. But I want to give this a subheading. So we're moving into some of the most popular strategies that pros would use heading into an earnings report. Does that make sense? Is that what you're going with?
We could do a whole piece on earnings because it's coming up. We could wait about a week or so.
That's why I mentioned the time spread. That's why I mentioned the time spread trades. Go ahead.
Yeah. So here's what I'm looking. Look, I mean, the earnings are jacked for a reason. So what I want to do is I am a seller. I don't want to sound like I'm obsessing about anything, but I'm a seller of these Feb 75s. And what I want to do is, let me see if I can get this. I want to buy the. Wait a minute. Hold on one sec.
That's right.
I want to buy the.
While you're lining up, I want to set the table on this. A lot of times going into earnings season or pre-event, what you'll have is you'll see people who want to speculate on the market. As I mentioned, they'll buy maybe a 60 delta call or a 60 delta put if they have an opinion. And what they'll do is they'll drive up the very short end of the curve because they don't want to lay out a lot of risk premium for an earnings thing. You don't go out and buy a 6-month option when you're looking at a 2-day event. And so what ends up happening is the front part of the curve ends up getting driven up almost like a backwardation situation. And professionals like Tom, who like to take advantage of professional speculators who are betting on the earnings, Tom will look at the front part of the curve as being overbought relative to the deferred part. And correct me if I'm wrong, he'll see that as an opportunity where if he sold the front part of the curve, whatever options, whatever direction, his direction would be dependent on if he was bullish or bearish himself, and then bought a hedged option, same strike to keep it simple, in a deferred month, he would take advantage of once that news came out. He's betting that the volatility decrease in the front post event would outweigh any directional move in negative gamma. Now that might be a little bit much to handle, but it's kind of like this. It's kind of like, look at the VIX. It goes backwardated before, let's say it went backwardated before move. Then you sell the front of the VIX, you buy the back of the VIX, and you say, I don't think the move's going to happen enough to justify that lopsidedness or inversion. And then sure enough, after the earnings come out, 8 times out of 10, that does happen. And that's one of the things Tom does playing against the professionals that I see. Does that make sense?
Yeah, that's exactly right. Like I like here this Nvidia thing. I mean, like, I'm long the 65.75 1 by 2 in Feb, right? Plus 7 cents for argument's sake, right?
Right.
I'll do it in tranches, right? So boom, boom, boom. And then I'm trying to bid. I was trying to do it for 40 cents till I didn't get. Blah, blah. Okay, here. Now what I want to do is, I think these things are so jacked. You look at the vol here. I mean, there's no freaking skew between these strikes.
Right.
Maybe a click between the 65s and 75. So it's flat. I automatically, like, I want to buy that skew. It doesn't cost me anything. So I'm a buyer of the downside stuff here and a seller of the upside. So, but I say, let me look at the time. So I go out to Feb, and I know I'm buying like 45 vol. I can't get it up for some. I'm going out to March. I could buy 45 vol. So I want to buy this March 80. Right? You see this March 80. By the March 80 call, so the Feb 75 call. I'm bidding 36 cents. Things like, roughly 45 cents. I'm bidding 36 cents. That gives me a lot of freaking latitude. You're going to need this stock to go to, by Feb expiration, 185 for me to be wrong.
Were you just beating up your mouse?
Was I just what? No,
Beating
I was playing with my pen. Playing with my pen. Look, I mean, you see me talk about it a lot in these webinars with Vince and in the chat. I'm giving myself a lot of room here. Look, if the stock, to me, the optimal thing is for the stock to go out of my short option, right? If the stock goes to 175, home run. These go out worthless, and I own these. These are probably, out 6 weeks from now. These are probably in the same spot they are right now. Maybe a little bit higher, maybe $2 for the stock at 170, maybe $3. It's a huge one. Look, I don't even need that much. We go to 165, 160. I'm a win. And plus, I took in a credit. Well, I'm doing this. I'll be paying 45 cents or 36 cents for this. I don't need a lot. I get 150 in this stock by the end of February. I'm a winner. The spread's about $1.50 because these things, the March 80s are going to maintain some premium, obviously, because you're not paying up for them. So all I want to do is I want to leverage higher vol. I want to make a directional bet, leveraging the higher vol against the cheaper vol. That's all I try and do all day. Does it work all the time? Of course not. But vol's a mean reverter. Period. This is a trade we did about 2 weeks ago, and I think Gary Eisenreich got it on. Kudos to him. Why he followed me into the abyss is beyond me, but that's okay. Onward, rode the Brave 600. Where is this thing? Bear with me for 1 second. Here it is. Why do I have difficulty with this? Let me just.
So while he's doing that, John and everyone else, directional pros like to keep it simple. A three-way option strategy is, let me, okay, I'll come back to my thought later. A three-way is basically, I want you to look at a three-way this way. While he's looking that information up. It's a three-way because 3 strikes are involved. And it's a directional trade put on by the initiator for the purposes of either hedging or expressing an opinion directionally. Now, it's called the three-way. I want you to look at it this way. If I say we're looking at oil's trading roughly $50 and I'm a producer and my cost of production is $35, I'm going to buy the 35 put. I'm going to buy the 35 put. All right. And I need that to hedge my production. That's where I'm cash flow neutral. And like any good producer or anyone who's long stock, I will sell a call against it that I don't mind selling oil at. So it's like, before it goes to $70, I'm not worried about that. So I buy the 35 put. Let's say it costs $1, and then I sell the 70 call, and that costs 50 cents. So what I've done is I've put on a collar or a risk reversal or a fence, depending on if you use New York or Chicago terminology. I'm long a put and short a call. Now it becomes a three-way when the guy says, yeah, but I'm still laying out 50 cents. I spent $1 on the put and I sold the call for 50 cents. Why don't I just sell the 25 put? Well, why would you sell a put if you're a producer and you're worried about the market going down? Because I happen to know it's not going to go below 25. Because if it goes below 25, everyone's going to shut their rigs down. I'll take that risk. So they end up buying the 35 put to hedge their production. They end up selling the 70 call because they don't care if it goes to 70. They have no problem making delivery. And they end up selling the 25 put because they really don't think it's going to go below $25 because of their fundamental information. So you can express it the three-way by looking at it this way. It's a fence, or I should say risk reversal, with another put added to it, right? You're long a put, short a call, and then short another put. Or look at it as a directional guy saying, it's a put spread that I bought, and I sold another call, and I sold a call to finance it. The P&L graph would look like a witch's hat or a butterfly with one leg missing. It would basically look like a fence. A fence is basically an S curve, right? A lateral line, a diagonal line, a lateral line, and then what would happen is on the put side, on the left-hand side of the curve, it would go down again. So that's an example of a three-way. A three-way is anything that involves three options. The most common is an out-of-the-money put spread versus an out-of-the-money call. So I'm going to bring it back to Tom because this spread that he and Geisenreich did should be discussed. I think it's probably a great example of a professional's trade. Cool.
Yeah, cool. I mean, this is I mean, Gary might know better than I think it's December 26th. Okay, whatever the day after Christmas, I think it was. Anyway, end of the day, I'm looking for something to do. I think Vol might have reached its apex some point that day. So I want to bet up, but I don't want to pay up because I mean the Vol's on the moon. How do you can't buy out of the money call. That's the biggest thing I would tell everybody in this freaking chat. You get a decline, much like what we had there, where Vol's elevated, VIX is 30 plus, whatever the heck it was, say 25 plus. You got to be real careful buying upside calls. You're going to buy upside calls there, and if the market rallies, you lose. You got to get that through your head. Your worst enemy in that scenario is a rally, because what happens when the market starts to rally, the starch comes out of the disaster puts, and then it spreads like a freaking disease through every strike up the line. So as the disaster puts go down, the 30 and 35 and 40 delta puts come in, and then the upside call starts to come in. Everything gets affected. So I think it's December 26th. We're trading 246. Big rally, I think, end of day. Yeah, that's right. I remember we were trading 2,400 at like 1 or 2 o'clock, and then we just took off at the end of the day. Somebody, I think we played 24.20. Anyway, we were close 24.70. I think with the spider trading 247 ish. I mean, this thing really wasn't any type of long delta. It was just more of a vol trade more than anything else. It might have been a slight long. So I wanted to buy. I want to look. I think the stock can go to whatever the hell I was looking at. I was thinking right in here. I mean, this 25.70 level it got to this morning, I thought was significant. Blah 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 blah. Okay, I want to structure something around 265, 270 out a month. They always go a little bit further than you think, right? We're not that good. We're not that precise. So I said, I want to buy the Feb 260s. Now, this is called a Christmas tree. So it's shaped like the branches of a tree, right? The lower branches are, wider and they get narrower as you go up. So I want to buy the Feb 260 call, sell the Feb 265 and sell the Feb 270 call. And I think at the time I think I paid 17 cents because I'm retail. Then Gary paid 16 behind me. And then I think I did it in 3 tranches. I paid 11, I paid even. Because obviously you never get the bottom and you never get the top. So I'm in it for about a dime. I mean, you've had this relentless rally, and I will tell you this. I'll guarantee you these I'll if I could go trade my ledger, I would guarantee you, Gary, you might know this. I may football the entire screen. I think every option here is lower. Every option, Gary, am I right? If you could check it out, I think every option here is cheaper than where it was when I bought it, when I bought this spread. The reason I made money is because I'm short 2 options and long 1. You follow me? So these things here might be up a couple of pennies, but these are down. These are the Feb 65s. You bought these. The stock's trading 247. We rallied 10. Wait, we rallied about 8 or 9 handles off of that, and you're a loser. Now, why? Directionally, I was right. Yeah, but you're paying premium volatility. That's why the upside call is you got to avoid that at all costs. If you think the market's oversold and it's going to go higher, I think you just got to be. You want to use it to spread against. You want to be a seller of options at that point in time. I'm not really. I don't want to advocate to people to be a 1x2 put tree guy. I don't know. I don't know how eager I am to do that. So I will not tell anybody else to do the same thing. But I think when you get situations or scenarios that present themselves like happened 2 or 3 weeks ago, these are the way to go. Something like this, trees, or the 1x2 like I did in NVIDIA. Here, I mean, well, like Gary could probably tell me, these things, every option is lower. We went $8 higher, roughly 3%, 3.5% higher in 2 weeks. And these are 6-week options, and every option is lower. The spread's out to about $1. All right. I'm in it for about a dime. That's a good return. Now, that was kind of, I mean, I was betting higher, but I wasn't really undertaking any delta. And I certainly wasn't undertaking any cost. I was just betting that if the market did go higher, vol would, mean revert, which it does. I mean, that's a fact, not fake news. It's going to mean revert somewhat to, somewhere near historical norms. I don't think it's going to go down to like 11 anymore, 10, not for a while anyway. So that's why this trade is successful right now. It's because every option's lower. I'm up. Yeah, 260's up 75 cents. Thanks, Gary. The 265's flat and the 270's down 35. Thank you, Gary. You see that in the chat, right? Thanks, Gary. I want to type that out in case you didn't hear me. So that's what, of course, he heard me because he wouldn't respond. So that's why we made money, right? Because the 260s are up 75. We had a 70 handle rally, 80 handle rally. They're up 75 cents.
Right.
I mean, the reason I made money is because the other stuff didn't move, and the wing on the outside wing was down 35 cents. That's why I made money, not because I was right directionally. Because directionally, I would have gotten. If I would have put the 265 calls, I'm breaking even and pulling my hair out. And God help me if I sold stock along the way.
Right.
Then I got it going. I'm wrong the other way. So that's what I would look to do. You get moves like that. You want to be a seller of volatility. So look, sell the upside. NVIDIA, here's, I think that's a decent stock to look at. I was doing 1x2s or leverage. The leverage you were speaking about backwardation, and it's definitely backwardated in some of these stocks. Leverage that freaking front month, sell that, and buy something further out. I know it's an earnings month, and you probably won't get paid right away, but I mean you're getting paid. You are getting paid to take the other side of that bet. And that's why I think this kind of stuff works. So I think NVIDIA, look at I put this in the chat a lot. I trade this thing. I've been trading it for, like I said, you have to be an adrenaline junkie to really get into it. Where is it now? Where is my little, is this it? This should be it right here. Did I come up? That should be, what is it? What do you see? Is that Twilio?
Yeah.
Yes. I mean, look at this thing. This thing's had an enormous freaking range today. Traded as high as almost traded 101, traded down to 93. It was $73 2 weeks ago. It was $82 last week. I mean, all I've been doing here is I have Jan 18 options. Okay. And look, I mean, I was lucky to get the move, because if I didn't get the move, I'm eating a lot of theta. Now I have Jan 18 options spread against some Feb stuff that I did a long time ago, but there's been some utility that I've taken advantage of there. But that's what I have. So what I've been doing, when I got the move yesterday, okay, I sold stock 92. I sold stock 95 and a half. I sold stock this morning at 99. All right. Then I'm also selling. I've been buying. I've been selling these calls. The this week's stuff is jacked for obvious reasons, right? I mean, you got desperate shorts and nervous longs or greedy longs. I've been trying to sell. I think I sold these. And I bought next week's. I bought these pars. I think I paid 40 cents. Yeah, I mean, I did this thing. It was a stock. The stock's down by 95. I did this spread Here, stock right here. Give it take 20 cents. I paid 40 cents for it. It's worth what about 92, 93 cents? That was yesterday because you're getting GM. Look, the stock could be 110, right? I could be dead wrong. But I'm giving myself a lot of room here because you look at the volatility of trading. It's 73 vol. You don't have to trade a lot here to get paid, right? I mean, it's $100 stock with 73 volatility. It's jump ball all day long in here for whatever reason. But here, I mean, you want to avail yourself. I want to sell that. I can buy 71 vol. I was doing it better than this, but you can see that stuff that's 71 vol, and this stuff, well, now it's flattened out. But this stuff was like 85 was 90 to 100 yesterday. It was ridiculous. Look, I mean, obviously, because what you're getting now is just geometric decay, right? Tickety tock. We go from 4 days to 3 days. It's coming in. The other stuff, the 10-day stuff, the GN18 stuff is going to decay more on a linear basis, whereas this stuff has geometric decay. What I was trying to do on the decline here, I didn't buy any stock, much to my chagrin. I'm trying to leverage. There's a gap here. If you look at the chart, I think it's down to 89 and a half, somewhere 88, 89 and a half. So I'm not up here. I want to still do it on the sell-off. I'm trying to sell these 88 and a half puts, and I want to sell more of these par calls, and I want to buy some Jan 25 pars. That's what I'm doing there. So I just want to finance them. I want to get some cheap long deltas here by selling a put where the market might sell. I mean, if it doesn't, that's okay. I'm sure that's fine. I don't want to buy the stock here. Okay. I sold the stock. I'm not really interested in buying a stock. I know I could have, and would have made 3 or 4 points, but I'm not really interested in buying a stock at 92. Yeah. Tomorrow will be 105. I'm not interested in buying a stock at 92 here. I think this thing was 73 last week. I'll be a real good buyer around 81 if I get the freaking shot. I don't want to buy it. I'd rather sell a jacked up put, stay in the game through options. So that's what I'm looking to do in Twillo if I get the opportunity. Period.
I think I want to add something to this because everything you're saying is reminding me of the original question. There are, what do the pros do? And I'm gonna just because what Tom is saying is what a professional does, and who he's trading against is a professional. So allow me to get this to you. For this conversation, there are 3 types of professionals, and to know the professional's axe to grind or what their bias is to know their trade of preference. So the directional professional who trades options will trade the simplest structure possible. Why? Because he's got a lot of money. Call it a 60 delta call, even call it a 20 delta call. Or call it, or he could be selling it. So they will trade a single outright option, keeps commissions down, doesn't telegraph what they're doing, and allows them infinite flexibility. They can convert the calls to puts, et cetera, et cetera. Now, the second type of professional, and this is important to follow because this is how the third type of professional, Tom, makes his money. In this conversation, I'm the second type of professional. I'm a market maker. And when the market drops, market makers are concerned with the micro. So when the market drops, we're talking about stocks here, volatility will blow out because of a stochastic difference in skew. Because it's a put skew, vol will blow out. So what ends up happening is everyone and their mother is buying 20 delta puts from me as the market's dropping, not Tom. So what I'll do is I will buy a 40 delta call because by me hedging that, it covers my volatility exposure. If the market keeps going lower, I'm short futures. So in the micro, I'm making money. I'm making ticks here and there as a market maker. I'm a bookie trying to hedge his risk. But what happens is market makers such as myself are so obsessed with each tick and each micro point that they leave bigger picture trades out there for people with the patience and ability to see the opportunity and attack it. So for example, if the market drops and volatility is up 3% at the money, let's just say, the puts would be up 3.5% because the skew would go even more. And the calls would be up 2.5%, a little bit less than the at the money. So that's because as we're dropping, all I'm doing is selling puts to people who want to buy them as a market maker. And all I'm doing is buying calls from people who want to sell them and hedging them aggressively. A guy like Tom steps into that after the move lower and says, wow, vol is really high. And he could say one of several things. One of them is, I think we're going to go down. I don't think volatility is going to perform in this next leg lower, or I have enough capital on my account that I'm not worried about a margin call. I'll buy one put and sell two puts to finance it. Why? That gets paid a credit. That's one way to express macro opportunity from micro traders like myself pushing the market around. A second way is he could turn bullish and say, you know what? I'm bullish, but I don't want to sell anything. I'm going to buy a one and sell the two on a call spread. Call that a flat trade. And the reason that works, which he just described, is while I'm worried about the micro, every tick is, I'm worried about every moment. I'm a shark who's constantly swimming around. Tom's going like looking like this. If you expand your time horizon from 1 minute to 5 days, if we rally, unless we rally because there's, because there's world peace and it goes to infinity, vol's going to come in on the initial move higher. And so while the at the monies were up 3%, they're going to drop 3%. The out of the money puts will stay sticky and they'll remain up 0.5% relative to at the money. And the out of the money calls will get annihilated from trapped longs who have to sell. The reason I bring this up is because if you know why people do what they do, you're less scared of it. You don't have to know how to build a clock to tell time. But once you know how a clock works, it makes you more comfortable stomaching risk. So Tom knows how a clock works. He knows there's guys out there like me that are getting hammered being short puts. And so we buy calls and we drive the calls up just to be long vol. And when the market stops, he picks a direction and he says, well, I'm going to use their micro concerns to make my macro trade. And that's what he does when opportunity knocks. Is that fair, Tom?
That's more than fair. That's 100% spot on. That's all I'm looking to do. Right, my time horizon's a little bit longer. I'm not day trading.
Right. But that's a professional's trade, whether it be a vertical trade, which you've been describing, or a time spread. You seek to capitalize on the short-term panic of people running into the market, and or the short-term vol panic of market makers like myself who will pay up for calls because that's the only thing available. Oh, I need to buy a Cabernet for dinner. My wife is going to kill me. I can't buy a Cabernet. All the Cabernets are sold out. Oh, crap. I guess I'll buy a Merlot. You bring it home and she gets mad at you, but at least you have something to drink. Meanwhile, the next day, you can't sell your Merlot back on the market because nobody wants it. People still want Cabernet, even though the prices are down, and you just can't get rid of it. And that's what Tom's doing. Tom's saying, you want Merlot instead of Cabernet? Yours, and I'll buy the Cabernet at the higher price and sell you two Merlot at the higher price. And that's a horrible analogy, but that's the idea. Substitution of options is what drives up options that shouldn't be bid up higher. And guys like Tom will step in and play the other side of it. And believe me, when I see a trader like Tom step in, I would see this a lot from the merchant energy firms. They would come in and they would just sell the skew when it got crazy in natural gas. That's when I knew that I was looking too micro and I was using the macro view. And sure enough, I would get hurt because of that.
Yeah, that's and Ben, I'll go back to my days on the floor. On Motorola, I mean, and that's often because you're taking a passive role. You're being the bookmaker and booking someone else's bet. So that is probably that would be the overarching reason why you would be forced into having a more narrower focus, because all of a sudden you get jammed on the front week or whatever the heck it might be, or the front month, and there's your pain. Now, what do I do to stop it? And if I'm short something there, where do I reach and go buy vol? And
right.
I mean, like I think I've spoken about this with Mike, and I'm sure you have with Larry. When you're wrong and you're short, whatever you're short, there's always that spot where you're gonna reach for anything just to put something on your sheet to stop the bleeding. Right? It just is. Everybody does it. I do it. You do it. Larry does it. Everybody does it.
Right.
Except for guys on CNBC, but that's a story for another day. That's what people do. That's just human nature. So I think as a market maker, and I've been in the same boat you've been, trading trading spiders, but more, but definitely in Motorola, where you get a guy drumming up 1 week. And it's funny that trade there with Morgan Stanley at the start of this. Boom, boom. This guy buys 4,000 calls on a 110 line, but the stock goes from 105 to 108 to 103. But all of a sudden now you just had an earthquake. Now people are worried about tremors. So now that vol has gone from, I'm going to say it's 45 to 50, whatever the heck it might be. And all of a sudden, a day goes by and it hasn't come down yet because it's fresh in my mind what happened yesterday. Right? Now all of a sudden, I got a guy coming in. It wasn't Sachin, it was somebody else. He wants to buy 1 year options and sell the front week, and he's
Right.
doing it on a ratio.
Right.
You know, he's buying. Look, you know as well as I do. These longer term stuff, 1 year, 2 year out stuff. I mean, they're like a tanker ship out there on the ocean.
Yeah, you may as well buy the stock. Yeah, exactly.
Right. But yeah, in terms of volatility, they're going to be they are going to present a volatility that is historically, somewhere near, somewhere near the mean for the stock, right? I mean,
Right.
if the stock is a 20 vol thing, that 1 year stuff should trade, 19 to 21 pretty much all the time, right?
Right.
Because I mean, rarely does the wave affect, does
Right.
the aftershocks affect
The marginal
capital out,
utility of volatility at infinite time is flat. The curve has to go flat somewhere, and
right. So we didn't drum up. We didn't. This is back in the day when we were like quoting stuff orally and like or verbally and putting stuff up on the screen, moving markets that way. We didn't really concern ourselves with the 1 year options because
Right.
that's not where we had issues. We had issues in the fronts. So all of a sudden, I mean, this guy, he's buying these 1 year and 2 year things 1x2 against us, and we're short a lot of options in the front. So we want to buy them back. But all of a sudden, after a day or two,
Yes.
after a day or two, this stuff is freaking the stuff we are probably, I'll be honest, flat to probably long a little bit of it.
Right.
He's
you're
still
not
got more to go.
30 days. And you're not moving for the next 30 days.
Right. And exactly. And he paid whatever that long-term vol was, 28, sold us 53. And he did it in a ratio, and it was a freaking bloodbath.
Right.
That's to your story, that the same things happened to me, and it's probably happened to anybody else who has played the part of market maker in a floor-based,
Exactly.
auction, open outcry option fund.
It's 150, and we may not be wrapping it up right now, but I just want to reiterate what Tom said in response to a question that's actually been good enough to take the whole session up, and I'm actually thankful for it. When you talk about what professionals prefer, as opposed to you could put your own bias in there and your own predilection. As a professional market maker and my own risk profile, I'm most comfortable taking the opposite side of players who like to do three ways. And you can look at it this way: Tom, as a professional, and I may be misquoting, but generally speaking, is most comfortable stomaching the risk on the opposite side of market makers who bid up vol because they're in a panic. Now, generally speaking, directional players will go with a very simple option. They don't buy call spreads. They don't buy butterflies. They're either going to buy a straddle, sell a strangle, buy a call, buy a put. They want to keep it simple to keep their options open. The more complex strategies that you see out there are basically licenses to get hosed unless you know what you're doing. A 1x2, if you don't know what you're doing, can kill you. Another thing that professionals will do is premium killers. They will sell strangles. What you did see in the first iteration of the VIX, for example, is the VIX was imperfectly created so that it was too centered on the at the money. So if you bought the VIX and sold an out of the money strangle because of the weighting of the VIX index, you could arbitrage the wings out of the market and make 5% no risk. That's why you would see even more selling of strangles in the past. But they redid the VIX to replicate the kurtosis or wings. So professionals will continue to sell strangles. That's one way. Buy a call. That's another way, or buy a put. And then when you get into the professionals who prey upon professionals, that'll be market makers like me preying upon three-way buyers so I can fade them because I know they're coming, or professionals like Tom who step in and see things get too far away from the mean, and he'll take the opposite side of it, managing risk reward. But generally speaking, it's easier to say this: professional options players do not trade butterflies intentionally. They do not do call spreads, and they do not do fences, collars, or risk reversals unless they're hedging a position. Directionally speaking, they will just keep it simple. Why would you pay for 3 or 4 or 5 options in a structure when you have billions and billions of dollars under management, when you could just buy the underlying and put in a tight stop? It's the same loss for them. They don't care. When you're dealing with market makers like myself who see you coming, when you quote a butterfly, to Gabe's question, what's the worst structure? Well, the worst structure because we see you coming, is a butterfly. When you quote an out of the money butterfly, I know your retail, I know you're buying. If it's worth 6, market is 5, bid at 10, and you will pay up. And when you want to get out, when it's in the money, you will be punished. Butterflies are commission bombs as well. So that's all I have to add to that. Hope that helps.
No, yeah, I think you're absolutely right. You're absolutely freaking right. Like if I knew someone was rolling, retail was rolling, I mean, I would just push the market. I'd bid what it was worth.
Yeah, exactly.
Worth $2.
You're not afraid to take value, right?
What am I going to do? Yeah. In those days, I can make them, a quarter, probably 3/8 of a point wide. What am I risk? I'm risking nothing to maybe take in 37 cents on a $2 spread.
Correct.
So I have no downside, and 18% theoretical edge. If you take me, I would just push it. I'd even bid over fair value if I thought you were a seller. But hey, look.
Well, I've done that.
I got caught. I've gotten caught. And you got to eat them. You get caught. You got to freaking out of your market. But I'd like to think I was adept enough. I used to get a pretty good. I always had a good memory for what people did.
Correct.
They had on. You had to, right? I mean, you had to have that. So
you remember, right, when a structure is traded and you have it in your inventory, and it's 3 months later in the market, it's in the money. You have to say, okay, they're probably taking off. And this still applies in the over the counter in commodity options, as well as when you build structures like nat gas option strips on the screen. If someone says in natural gas, give me the $2, $5 fence for Cal 14 or for winter Novi March, they're buying put and selling call, because even though it's a call skew market in the wintertime, producers can come in to buy put and sell call, and that's what professionals do. It's 1:55, Tom. I have to jump. I don't know how much time we have, but I hope we've answered questions. And we should do a whole session on calendar spreads, which would be
let's do that tomorrow. You want to do that? You're going to be with me tomorrow?
I think so, Tom.
Done. We'll do time spreads tomorrow. Gary, you know your stuff. Maybe come up with some questions. Help us out. Anybody else? Johnny Hassinger, anybody else is out there? You got some questions.
Yeah, hope we answered your
homework
questions today. I'm gonna hop and leave you with Tom, but look forward to speaking with everyone again tomorrow.
Okay, take care, Vin.